Have you ever felt just overwhelmed by all the information out there,
Mm.
especially when it comes to investing?
Oh, absolutely.
Or maybe you've wondered what it really takes to invest wisely for the long haul, not just chasing the latest fad.
It's a huge challenge, right? The market is just so loud, full of noise. And cutting through that noise to find like durable wisdom, that's the skill. That's what really sets apart the investors who stick around.
Exactly. Yeah, that's pretty much our mission today. Welcome to the deep dive. We're going on kind of a fascinating journey digging deep into a really insightful source. A detailed annual letter from an investment firm called Giverny Capital.
Mhm.
This is their 2010 update to their partners. And our whole deep dive today is built entirely from excerpts of that original 2010.pdf document.
Mm-hmm.
Letter itself, performance tables, even some images they included.
Yeah, our goal here is to really pull out the most important nuggets of knowledge. We want to understand the mindset of this successful investment firm, more than a decade ago, how they saw the world, their philosophy, performance, the specific companies they were watching.
Think of this as your shortcut to understanding some core principles of long-term value investing. We're hoping for those aha moments that give you a fresh perspective on, like, market dynamics and how to really analyze a company.
Yeah, get under the hood a bit.
Okay, so let's open up this letter. Giverny Capital 2010 annual letter to our partners. Right off the bat, it sets this tone of resilience, overcoming challenges.
What's really striking, I think, is how the letter frames 2010 immediately. Not just about financial results, but as a year of, well, real recovery. The artwork they picked for the cover Barry Alakis's flyover, it's a great symbol for their portfolio companies, like soaring above what they called the ambient doom and gloom after the crisis.
And they really had the numbers to back that feeling up. For 2010, their portfolio return was 16.1%. Compare that to their benchmark's 13.8%, outperforming by 2.3%, even with Canadian currency swings factored in. That's pretty impressive for a recovery year.
And if you look at the bigger picture, their long-term performance is even more compelling. Since they started back in, mid-1993?
Yeah, July 1st.
Right. They got an annual compounded return of 13.9%.
Yeah.
Benchmark, 7.1%. That's an annualized outperformance of 6.8% over 17 years.
Wow.
So the crucial question this raises for you listening is, what fundamental principles really allowed for that kind of consistent long-term outperformance? What were they doing right?
And they weren't shy about their goals either. They set a clear objective, maintain an annual return 5% higher than their benchmark. The letter breaks down their U.S. portfolio and their Canada portfolio.
Okay.
The U.S. one, all in U.S. dollars, really shown in 2010, returned 21.9% against the S&P 500's 15.1%.
The difference.
Yeah. And since 93, it returned 14.7% annualized, significantly beating the S&P 500's 8.1%.
Their ability to spot opportunities is clear there. They specifically mentioned that in 2010, it was actually smaller companies like Fastenal, ResMed, Bank of the Ozarks, O'Reilly Automotive. They led the charge in the U.S. portfolio.
Huh, interesting.
Which is kind of interesting because it contrasts with their view that the big American blue chips, the established giants, they thought those were trading at compelling valuations not seen in decades.
Right.
They talked about average PE ratios dropping from like 33 times earnings back in 98 down to just 11 times then.
Wow, 33 down to 11.
Yeah. And what's compelling about that 11x PE, think about it, is it implies you could theoretically get your investment back in earnings in just 11 years. Compare that to the dot-com era, 33x PE. You're waiting 3 times as long. It just highlights how much value Giverny saw in those established companies, even if the smaller ones led that specific year.
Makes sense. Okay, and on the Canadian side, the Giverny Canada portfolio, launched in 2007, also had a stellar year. Returned 26.7% in 2010 against a 17.6% benchmark.
Nice.
They'd outperformed the TSX in 3 out of its 4 years, with MTY Food Group, their largest Canadian holding, rising about 50% just in 2010.
The letter really does capture the economic feeling of 2010, doesn't it? It was this mix of caution, but also optimism. Giverny actually proclaimed the beginning of a bull market that will last for years to come.
Old call.
Yeah, noting North American GDP growth was nearing 2.6%. That felt like a clear sign the worst of the recession was over and those, apocalyptic scenarios hadn't actually happened.
But even with that positive economic news, Giverny wasn't exactly wearing rose-tinted glasses, right? They saw plenty of big challenges still out there for 2010.
Yeah.
What were some of those things they highlighted?
Well, they pointed to Canadian consumer debt hitting a record 150% debt-to-revenue ratio. Oof. Yeah, basically the average household owed 1.5 times their annual disposable income. That's a serious headwind for future growth, right? They also noted government stretching their borrowing limits, intense global competition, and increasing government interference with successful businesses. They mentioned Visa, MasterCard, Google, even medical product companies.
Okay.
But what's crucial here is their core philosophy for navigating this stuff. They acknowledged their opinions on government intervention were, and I quote, secondary to our role as stewards of your capital.
Pragmatic.
Very. It shows this deep-seated humility, realism, and just reliance on reason to navigate the business world, but combined with an unwavering confidence in human potential in the long term. It's a very practical, long-view perspective despite those immediate challenges.
Speaking of long-term thinking, the letter actually dedicates a section to the passing of an investing legend, Roy Neuberger. He died at 107 in 2010. His story is pretty incredible.
It really is.
He started his career in 1929, just months before the crash, and famously sold RCA short. Only lost 15% of his capital when everyone else was getting wiped out.
And what's truly fascinating is Neuberger's just enduring passion for the market, even past 100 years old, right in the middle of the financial storm, March 2009.
Yeah.
He calls up a Neuberger Berman executive and tells him, listen, young man, if you don't find a way to invest my cash, I'm going to find someone else to do it.
Wow, at the bottom.
That's conviction, right? And apparently that led directly to massive market buying right at what turned out to be the low point.
He had a great way of describing the market, too. Called it a sheep market, not bull or bear, because most investors just follow the crowd.
How that?
His advice was study the past and to become your own historian, having lived through fads like bowling alley companies in the 1950s. And he had this other passion art. He actually aimed to get rich on Wall Street, specifically to buy art. Got early works by Jackson Pollock, Edward Hopper.
That's amazing. Neuberger's longevity and that unique perspective, it really begs the question, how do investors actually apply that kind of long-term owner-like thinking consistently?
Right.
And Giverny Capital ties right into this with their concept of owner's earnings. It's a method Warren Buffett created.
Okay, so what is owner's earnings exactly?
Well, it's not just the reported net income you see on the statement. It's the cash a business truly generates that's available to the owners after accounting for all the capital spending needed to maintain and grow the business.
Ah, okay. So the real free cash.
Exactly. It's a powerful distinction because it forces you to look beyond the short-term stock price wiggles and focus on the real economic growth and long-term prospects of the actual business underneath.
So what did that focus mean for their portfolio back in 2010? Well, Giverny reported the aggregated intrinsic value of their companies, their estimate of true worth, rose 22%. And interestingly, the stock market value of their portfolio also rose 22%.
Synchronized.
Yeah, but they noted that synchronization is rare, only the third time in 15 years. They emphasized that, quote, market performance and corporate performance are rarely synchronized over the course of a calendar year, but they do align over time.
And stepping back for a moment, their long-term analysis since '96 really drives this home, their companies. Intrinsic value up 493%, almost 6 times.
Wow.
Market value up 440%, pretty close. Now compare that to the S&P 500 over the same period. Intrinsic value up 162%, market value up 167%.
Big difference.
Huge. It vividly illustrates their core belief. In the long term, the market prices of companies approximately followed the growth in owners' earnings of its underlying business. It's really a testament to patience and fundamental analysis, isn't it?
Absolutely. Okay, another fascinating point from 2010 was the flavor of the day for many investors, gold. The letter calls gold a tenacious relic from another era.
Strong words. This brings us to a really fundamental question about true wealth creation. Giverny argued that historically commodity prices like the CRB index represents have actually failed to keep up with inflation by about 1% annually.
Why is that?
Mostly because of human ingenuity. We just get better and more efficient at extracting stuff. Now, gold did slightly outperform inflation over 100 years, returned about 4.3% annually versus 3.3% inflation.
Okay, so a little bit better.
A little bit. But stocks returned a staggering 1,300,000% over the same period.
Whoa.
Yeah, that's roughly 200 times better than gold.
So the letter declares this unequivocal truth. In the long run, gold hasn't been better than stocks and barely beats treasuries. Why should you, listening, care about this history?
Well, Giverny argues that just owning a yellow metal or lending money to governments, it doesn't actually create wealth. Businesses do. They create products, technology, medicine, services. owning a piece of those businesses is, as they put it, the authentic source of wealth creation.
Makes
And
sense.
they directly tackled the speculation on gold back then, which was driven by a loss of confidence in our capitalist system, their counter. A firm belief that, quote, betting against the progress of humanity and the improvement of our standard of living has always been a losing proposition.
Powerful statement.
Yeah, and they even quote Charlie Munger, Buffett's partner, who famously said, I don't have the slightest interest in gold. I don't see how you become rational hoarding gold. It's just a strong endorsement of productive assets over, passive stores of value.
Okay, let's turn our attention now to how Giverny actually put these philosophies into action within their portfolio. The letter notes this really fascinating disparity in late 2010. About 14% of the Canadian TSX market was made up of gold stocks.
14%.
Yeah, which seems wildly out of proportion when you consider Canada only produced about $4.2 billion in annual gold revenue then, which was tiny, like 0.3% of its GDP.
That highlights a crucial point, doesn't it? Market valuation versus the underlying economic reality. Giverny noted the Canadian stock market was trading at 158% of its GDP,
Compared to...
compared to the U.S. market, which was at a more historically typical 103% of its GDP. That huge gap suggested, maybe a potential disconnect up north.
So what did they think caused that?
They attributed it partly to an overvalued Canadian dollar. The OECD estimated it was maybe 20% overvalued then, and also slightly higher PE ratios for the Canadian market overall. They actually predicted this 55% disparity would shrink, putting the Canadian market at risk of underperforming the U.S.
But they still found Canadian stocks they liked.
Oh, yeah. Despite that broad caution, they still found terrific Canadian companies, mentioning MTY Food Group, Dollarama, and 5N Plus specifically.
Okay, so let's dig into some of those individual holdings. The letter gives some great insights, illustrating their philosophy of owning businesses that really widen their competitive moats, right? That sustainable advantage.
Exactly. Take Wells Fargo, WFC. Even right after the crisis, Giverny saw opportunity. Their earnings per share, EPS, was up 45% in 2010. Assets grew an amazing 155% in 4 years because they bought Wachovia,
Right, I see.
showing robust integration and growth potential. Then there's M&T Bank, MTB. Giverny held this up as just exceptional, profitable for 138 quarters in a row. EPS growing 15% annually since 1983. And get this. It was the only S&P 500 bank that did not cut its dividend or issue equity during the crisis. That's real financial strength.
Incredible resilience.
Microsoft, MSFT, was another one they thought was a bargain. EPS up 25% in 2010, driven by that huge Windows 7 migration and the surprise success of Kinect. Remember Kinect?
Oh yeah, the motion sensor thing.
Sold 8 million units in 60 days. Giverny just saw an undervalued tech giant there.
And their biggest Canadian holding.
MTY Food Group. MTYT, leader in Canadian restaurant franchises. Its EPS grew 23% in 2010 and an amazing 78% since Giverny first bought in 2007. Just shows consistent growth through that franchise model. And they mentioned others too, Bank of the Ozarks, ResMed, American Express, Fastenal, all showing strong earnings growth, solid competitive advantages.
Okay, beyond what they held,
Yeah.
they also talked about what they sold, their divestments. They sold Martin Marietta and Morningstar simply because they felt they were less undervalued compared to other things they could own.
Right, redeploying capital.
But here's an interesting case study. Natori, a Japanese retailer, they first bought it in 2007, partly because the yen was weak. They figured a stronger yen would boost margins, make imports cheaper for Natori.
Okay, makes sense. So what's fascinating is why they sold Natori in early 2011. Well, sales growth had slowed down, and the yen, it had appreciated like crazy, up 50% against the U.S. dollar in just 3.5 years.
Right.
That seemed unsustainable. It indicated future EPS growth would probably dip. So they locked in a pretty healthy 65% gain. It just shows their discipline, right?
Yeah.
Acting when the original investment thesis changes, even if it's a profitable position.
Right, not falling in love with your stocks.
Yeah.
Okay, what about new investments in 2010? Two stood out. First, Dollarama, the Canadian dollar store leader. Giverny saw lots of growth potential, even though it was already dominant. Noted sales jumped 14% in its first year as a public company.
And then there's Visa. Giverny really likes companies in the credit card space. They call it having the equivalent of a royalty on the growth of others, a concept Buffett also talks about.
Taking a small slice of lots of transactions.
Exactly. Visa showed great resilience during the crisis. EPS was up 72% in just 2 years. Now, this raises that crucial question. What about the risks?
Always risks.
And they were very transparent. They addressed Senator Dick Durbin's proposed amendment about debit card transaction fees. They acknowledged, yeah, this would likely lower Visa's profits by maybe 10% in 2012.
Okay, so a real headwind.
Definitely. But despite that, they still considered Visa undervalued because of its dominant market position and just that strong underlying business model.
All right, now for maybe one of the most honest and insightful parts of the whole letter, the mistake du jour section.
Ah, yes, the mistake of the day.
Where they actually give out medals for their best errors of 2010. And they emphasize something important. Errors of omission, things they didn't buy, are often more costly than errors of commission, things they did buy that maybe didn't work out. It's such a rare level of transparency.
It really is. And that commitment to systematic self-analysis is absolutely critical for learning and improving in investing. So let's look at their medals.
Okay, bronze.
Bronze medal went to Coach, the luxury handbag maker. They owned a little bit, but they passed on buying more during the crisis low when the stock was trading at just 5 times profits, even though they called it a world's greatest brand.
Way past.
Fear, just general fear about the luxury goods industry at that time. The stock later quadrupled. Ouch.
Ouch, indeed. Silver medal.
Google. They were genuinely impressed by the company. It called it a miracle of capitalism back in 2005. But they were skeptical of its dominance and that high valuation at its IPO in 2004, 50 times profits. So even when it dropped below $300 during the 08-09 dip, down to 15 times profits, they only slowly began buying. Then, summer 2010, it falls to $450 for no apparent reason.
Yeah.
They waited. They waited for an even better price and just completely missed the rapid bounce back to $600. Double ouch.
Okay, so what gets the gold medal for mistakes?
Intuitive Surgical, maker of the Da Vinci robotic surgery system. They totally understood the business, the competitive advantages. The stock crashed from $350 down to $85 during the crisis. Trading at about 14 times profits, no debt, cash on hand.
Sounds like a steal.
You'd think. But again, they bought a small starting position and waited for a better price, only to watch it quadruple back up to $345 as growth just came roaring back.
Triple ouch. This is fascinating, though, because the big lesson Giverny took away from all these missed chances during the crisis was really profound, wasn't it?
It was. They realized they should have been more ruthless. They should have sold their more conservative holdings. Think Walmart, Procter & Gamble, Johnson & Johnson stocks that hadn't fallen nearly as much and were therefore less undervalued.
And use that money to buy more of the deeply discounted ones.
Exactly. Buy the Googles, the Coaches, the Intuitive Surgicals that were trading at huge discounts.
So we connect that to the bigger picture.
It's all about that ruthless allocation of capital, right? Moving money to the most undervalued opportunities, even if it means selling solid, good companies that are just less compelling bargains at that moment. The letter actually says one should not hesitate to sell stocks trading at 60 cents to the dollar to buy stocks trading at 40 cents to the dollar.
That raises a really important question for you, the listener. How disciplined are you? Are you constantly reevaluating, ready to pivot from a good investment to potentially a great one?
It's tough to do in practice.
It really is. Okay, finally, the letter ends with this compelling concept, the wall of fear. They use U.S. consumer confidence as a key indicator of this wall.
Yeah, their thesis is pretty simple. When consumers are pessimistic, the market's usually low, and that's when you find numerous opportunities to create wealth.
And the opposite.
Conversely, when consumers are optimistic, the market's probably high, and maybe a pause or correction is likely.
So what's really insightful here is the historical data Giverny presented to back this up.
Right. They showed that when U.S. consumer confidence dropped below 70, and it was way down at 53 at the end of 2010, similar to levels in the 74, 82, 92 recessions, the S&P 500's return over the next 5 years was an impressive 116%.
Wow, 116%.
Yeah, or about 17% annualized. It strongly suggests that high levels of pessimism, that wall of fear, often signals great potential for the market for the years to come. It's just a powerful reminder that often the best chances pop up when everyone else is feeling the worst.
So wrapping up 2010, what did all this mean for you, the Giverny Capital partner, reading that letter back then?
Well, Giverny concluded the year believing there was still great potential for the market, particularly in those undervalued sectors. They emphasized their portfolio companies were in excellent financial health and trade at compelling valuation.
So we've journeyed through Giverny Capital's 2010 annual letter. We've uncovered their strategy for outperformance, that deep dive into fundamentals using owner's earnings, their pretty contrarian stance on gold, and those really humbling but valuable lessons from their mistake du jour. We've really seen how they tried to apply humility, realism, reason, but also kept that unwavering confidence in human potential.
Yeah, and the letter left us with a really powerful thought, didn't it? Quote, "The more irrational the stock market, the higher our chances are to attain our financial objectives."
That definitely invites you to consider. In this world just flooded with information and market noise, how much of your own investing strategy is really driven by careful analysis of the underlying business value?
Versus, getting swayed by the emotional pull of that wall of fear or just following the sheep market tendencies that Newberger talked about.
And maybe think about how applying those lessons from Giverny's mistake du jour, especially that willingness to sell good assets to buy great ones, how might that reshape your own approach to evaluating opportunities and managing your long-term financial goals?
Lots to chew on there.